share some of the experience that we've had and some of the expertise that we have around this. I know for me personally, as a technical consultant with Thomson Reuters, I've been going around really the nation across different cities and presenting to some of our users of our software and our applications around the new tax law. And I've been getting a lot of feedback, a lot of firsthand interaction with tax practitioners across the nation who are in the same boat as you. And if you're listening to us today, whether through Facebook or through Zoom, I'm sure you're anticipating some of these changes that are coming. And, well, they're already here. So there's a lot that we can talk about today. And I have a friend and colleague with me today as well, Sean. And Sean's going to be speaking with us and tag teaming this discussion with me a little bit. And I'll introduce Sean in just a moment, and we'll hear from him as well. So without further ado, here I want to go ahead and dive into things, folks, and talk to you a little bit about what's our objective for today. And if you've attended these sessions, I've already been presenting to the Latino Tax Pros audience 2 sessions prior, once in, November, and then once early in December. And this session is kind of a continuation of that. We're looking to take a practical approach to understanding these complex changes. As you all know, if you haven't heard, TCJA, Tax Cuts and Jobs Act, is happening this year. If you haven't heard of that, then I'm sure you've been living under a rock somewhere. So what we want to make sure we're doing is presenting some tools to you. So we have different tools, Quickfinder Handbooks, Planner CS as a software application, to be able to maximize some of these complex changes for your clients. Whenever I see changes to tax law over the past 5 to 6 years, it seems as though practitioners can make a choice. They can either adapt to take advantage of those changes, or maybe stay complacent and try to just change as needed. So we're trying to get ahead of the curve, providing you with tools and insight to maximizing your client's profit and providing them with a written tax plan, potentially using advanced tax planning tools. So I want to go and take a moment to introduce my colleague and friend here, Sean. Sean's an author and technical editor for our PPC products. His articles can be found in PPC's Practitioners Tax Action Bulletins. Sean has spent over 10 years with national accounting firms. Early in his career, he's led research and development tax incentive studies for various Fortune 500 companies. He's also specialized in due diligence, corporate restructurings, international tax compliance and planning. And he's worked with a variety of small businesses, advising them in a variety of ways. Sean is actually in Dallas. He's got his degree from Texas Tech and also went to NYU. So with that, Sean, I just want to go and introduce yourself. And if you have anything to add or anything you want to say, feel free to mention that now.
Yeah, thanks, Jeremiah. I'm an attorney, guys, so I hope that's okay with you guys. But I have worked a lot with CPA, so I'm really happy to be here. One thing I'd like to mention is I also work on the Quickfinder Tax Tips newsletter, which comes out once a month. So if you guys subscribe to that, you're going to get some valuable information.
Awesome. Thanks so much, Sean. And it's great because obviously Antonio and Nick are out in California. I'm here in Ann Arbor, Michigan, and Sean's in Dallas, Texas. So we're representing all different sides of the nation here today, it sounds like. Well, guys, our agenda for today, we're going to go through a lot of topics, and we're going to try to jump in right into things here. We're talking about the who, what, and when of Section 199A. That will be our major focus for today. That seems to be the hottest topic of TCJA. It's what everybody's talking about, and there's a lot of murkiness, I would say, around 199A and what it means. And so we're going to provide you with as much of a step-by-step approach to this deduction as we can within a 60-minute time frame. Keep in mind, folks, this is something that we could probably talk about for a good 8 hours plus. I mean, there's so much to this deduction that we're going to try to condense this down into a practical format for you as much as we can, and then also present you with some various helpful Thomson Reuters tools as well. So I want to go and ask a polling question here. Let's see if we can use our tools available through the Zoom platform. And I believe one of those tools is a chat or a Q&A function. So I want to see, to get some feedback from the audience here, how comfortable are you with the Section 199A deduction? And I think this is an interesting discussion. Sean presented this at our Synergy Users Conference early November. and it seemed like the majority was kind of on the fence, didn't really know yet about it. So I'm curious to know kind of where you folks are at with us today. So take a moment. If you're using Zoom, you should be able to use the chat panel. At the top of your window, there's a green panel. When you hover your mouse over the green panel, from there, click on the More icon. There's a little ellipsis button, dot, dot, dot button. You can click on More, and then from the More option, there is a chat. So take a moment to send a quick chat with a response, and being honest, please. Are you A, very comfortable with 199A? Are you B, familiar with it, but you want to know more? Are you C, you've heard of it, but you're waiting until next year? Well, next year's here, so we kind of want to make sure we're understanding it now. And then if you're in the category of D here, what is Section 199A? Well, you have a lot of research to do. So take a moment here. I'm getting some feedback. Thanks for those of you that are providing the feedback through the chat panel. And it looks like the majority of the chat that I'm getting are B. So I think that a lot of us are kind of in that category. You know, we're familiar with the basics. We've done a little bit of our own research, but we want to do more. We want to know more about this deduction and how to apply it to our client situations. So that's what we're going to talk about today, folks. I've got a lot of examples that we're going to go through, but to provide this timeline, kind of an idea here of what's happened over the past 12 months, really. In last December, Tax Cuts and Jobs Act was enacted. A day later, there was widespread panic. If you're like me, you remember exactly where you were when the TCJA was announced. It's almost like when national tragedies occur, you remember where you were at. That's kind of where I remember where I was when TCJA was announced. But then we had some proposed regulations just last August. There was a public hearing in October, and actually recently in December 19th, the IRS did release a draft version of Publication 535, I believe, which is something that provides us with a little bit more clarity on Section 199A. And they even had released the instructions for the brand new 1040 postcard with some of the detail on that as well. So we do have some additional insight based upon recent months. So the who, what, and when of this deduction here, as you can see, who, individuals, estates, and trusts. What, it's a deduction of up to 20% of your qualified business income. We're going to talk about exactly how to define QBI later on. It's coming from sole proprietorships or any pass-through entities. So maybe your clients come to you and say, hey, there's this new pass-through deduction that I've heard about. How can I attain that? So that'll be something you want to keep an eye out for. And then this is something that is going to apply for tax years 2018 through 2025, assuming there's no major overhaul in legislation. So with that being said, I want to take you through here, and I'm going to go ahead and kind of defer to Sean for this for a moment. And Sean, just kind of taking a look at these 8 easy steps, if you can help us to understand kind of the approach that you suggest firms and tax practitioners to take when they really approach this QBI deduction.
Great question. You know, the QBI deduction is incredibly complex, and a lot of practitioners get overwhelmed very easily. So what I have found is if you can break up the deduction into steps and you can identify the components of each step, that it makes it a little easier to get through the deduction. So I put easy in quotation marks because I don't want you to think that this is a very simple deduction necessarily. It could be for some clients, but with following these steps, you'll be able to go through the deduction a little more easily than if you were just reading the statute and regs. So here are the 8 steps that I suggest that you go through when you do the 199A deduction. And the first one is probably the most obvious, which is know the nature of your client's business. And a lot of people, when I tell that to them, they say, well, of course I know my client's business. But that's really important because depending on the nature of the business, the client may be limited in the amount of the deduction he or she gets. And you'll see the other 8 steps down there. Know your client's taxable income, identify QBI for each business. You're going to compute a deductible amount for each business. You're going to determine a combined QBI amount. We're going to apply the taxable income limit, calculate the final deduction, and of course, you got to report it on the tax return. So those are your 8 steps, and I think we're going to go into a little bit more detail now.
Absolutely awesome. So, I give a lot of credit to Sean because these 8 steps are something that I know a lot of practitioners are utilizing as they start to plan for how to maximize this for their clients. So let's get into some examples. We're going to dive right into things here, folks. And the first example that we have here is a client. We'll say Julie is a client of ours, and perhaps Sean and I are working in a hypothetical world where we have our own tax firm. So we have a client, Julie. Julie's a partner in a successful law firm. So Julie has a 2018 Schedule K-1 coming from her partnership 1065 return showing ordinary business income of $500,000. Julie's going to be filing joint with her husband in 2018, and their taxable income before any Section 199A deduction is $1.2 million. So the question here, folks, is Julie's share of the law firm's income eligible for the deduction? So what I'd like to do to get some participation here, and it's always good to get some interaction with folks here in these webinars like this. If you're on Zoom, use the chat, the same function we used for the polling question earlier. And if you have an idea of your answer to this question, is Julie's share of the law firm's income eligible for the deduction? A simple yes or no response. Please let us know in the chat. So once again, to access the chat, when you hover your mouse over the top middle section of your window, there should be a green panel up there. And when you have your mouse over that green panel, find the more icon, and then from there, click on the chat. So give us a simple yes or no response. We're getting a couple of responses here from folks saying, looks like a couple of folks saying no. Okay, so any other responses, please let us know that. We'll leave it open for just another few seconds. And I'm thinking the few folks here, I'm getting a couple more no's, maybe 1 or 2 people saying yes, potentially. So even in the first step, right, we're getting some maybe differentiation in answers between folks that might think things that are eligible versus things that might not be. So I'm going to go ahead and allow Sean here to provide us with some detail here on the response. So Sean, what do you think? Is Julie's share eligible for the deduction?
Unfortunately, the answer is no. And the reason is she is in a specified service trade or business, what we call an SSTB. And that's because she is in the practice of law. So lawyers, accountants, things like that, they are going to be generally excluded from the deduction. However, if they have taxable income at or below a threshold, which we'll cover in a minute, they can actually treat the income as QBI. The thing here about Julie is her taxable income, married filing jointly, is too high. It's $1.2 million. So unfortunately, because her taxable income is too high, she can't take the deduction because she is a specified service trade or business.
Now, Sean, if I were to come to you, say you're my accountant, and I were to ask you that question, I'm sure that a lot of accountants are going to get this question this tax year, is my business a specified service or trade business? How would you tell, or what are some resources that you might use to be able to answer that question?
Great question. So a lot of our products at TR, they have pretty good summaries. So tables, for example, that summarize each of the fields that are considered specified service trades or businesses. I suggest that you start with one of those tables because it will give you kind of a good overview of what we're looking at here. Now, there are some situations where it's not so clear cut. And in those situations, you're going to have to do more of a facts and circumstances test. And we have some factors that you can look at in our publications that will help you along the way. But generally, if you look at our tables, that'll be a good beginning point to tell clients whether they're an SSTB or not.
Awesome. And, I want to share some of the tables that Sean is talking about with you here today, folks. One of the tools that I've absolutely fallen in love with over recent months is something called the Quickfinder. So we offer these Quickfinder handbooks through our Checkpoint products. And I'm going to go ahead and pull up our Quickfinder ebook series here. And the idea with this Quickfinder ebook series is that I can purchase these handbooks for roughly about $50 a piece, so not too cost prohibitive. And the idea is that I have now hundreds and hundreds of pages at my fingertips of resources that is up to date and accurate around these new tax laws. So the 2018 1040 Quickfinder Handbook is one that I'm going to share with you here, and it actually decided to log me out, so bear with me as I log back in here. And this is a really cool piece of technology here. When I click into this ebook or this handbook here, as I said before, I now have hundreds and hundreds of pages at my fingertips, and it's easily navigatable. I can easily navigate here using this table of contents. I can scroll up and scroll down and find all these different pages and information. But you know, rather than having to fish through the different content here, there's a search box. So I could always search different things here like SSTB perhaps. And there is some information regarding identifying QBI, specified service, trades, or business. So when I click this, oh my goodness, there's 26 different references in this ebook around specified service, trades, or businesses. So that's one way to use this book. There's also an index. So I really like this index because potentially if we're talking about qualified business income deduction, I come out here to the Q section. If I can click here, and maybe the clicking mechanism doesn't seem to be working for me right now, but, oh, and you know why? Because I have a search on. So let me go ahead and eliminate my search here first. And now when I go out to my index, I can click here to Q, and hey, there's a bunch of stuff related to qualified business income deduction. Something I know a lot of people are going to be looking towards is the accuracy related penalty. What is that going to look like if we're not necessarily completely accurate with this deduction? What is the penalty going to look like? And so this is where we can see here things like specified service or trade business. These are some of those tables that Sean was talking about. So this is extremely valuable. You can print this out. You can use this as a tool. You can annotate this. You can highlight things, add notes. I mean, there's a lot of different information content that is available here to you through these Quickfinder handbooks. So what we're going to share with you today is through the PowerPoint slide, if I can get back there, we do have some samples of these tables that we did pull from our Quickfinder handbooks. And if you are listening in and you're a member of Latino Tax Pros and you're listening through Zoom, we'll make sure to get you copies of these slides post our session today. So we'll get that out to Latino Tax Pros and we'll make sure to send that out to you. But this is a good starting point. Now, as Sean said, there are going to be some gray areas potentially where you'll want to make sure to do your own research and due diligence upon what is or isn't considered a specified service or trade business. So as I said before, I feel as though this is something that a lot of folks are going to be asking that question this tax season. Is my business a specified service or trade business? So we want to make sure that we're aware of what is included in that clause and what is excluded from that as well. So a lot of information here, folks, to read up on. Well, we're going to continue here, and we've got some further information on SSTBs. And Sean, I want to go ahead and pass it to you here because I think this is kind of an interesting definition. I have a hard time explaining this, so I'm going to go ahead and pass it off to you. What would be the best way for you to describe what would be a basic definition of an SSTB?
Well, so this principle that you see here on the screen, I think this was one of the most controversial principles that came out of the statute because all the statute said was you're an SSTB if the principal asset is the reputation or skill of one of the owners or employees of the business. And everyone kept saying, what does that mean? You know, virtually anything could fit in that definition. And so what happened, and this was a really good thing for taxpayers, it was very friendly for them, is the proposed regulations clarified it and narrowed it quite a bit. So I call this rule the Kardashian rule, because when you read it, it really applies to celebrities and people whose images or likenesses are very familiar to the public. So for example, if you're receiving income for endorsing products, let's say you're on Instagram and you're putting all these posts about a product you're selling, you're an SSTB. If you're licensing or receiving income for your image or your name, or it could even be your voice. If you have a very, interesting voice or something like that, and you get money for that, you're an SSTB. And then of course, let's say you're appearing on the red carpet or something like that, and you're getting fees for that, or you're getting fees from being at a club or something like that, you're going to be an SSTB. So Thankfully, the IRS narrowed that definition a lot. And so my guess is you won't have a lot of clients that fall into this category, though in LA you may, right? So, but this is kind of the narrowing of that principal asset clause, we call it.
Perfect. Thank you, Sean. That helps a little bit to understand some of the definition here for an SSTB. Thank you. Mm-hmm. Well, I've got another example here, and I think this is a good example because this helps us to understand a little bit more depth into our Section 199A. So to kind of set up the example here, and here in this client example in 2018, we've got a client, Jake. Jake's owning a computer warehouse business, and Jake has gross receipts of $22 million in 2018. 20.46 million of that amount, about 93%, is attributable to the sales of computers, software, and related accessories. So really sales income there. The remaining about 7% of their sales for the year is then from consulting, training, and installation services. So the question here for you all folks is Jake's computer warehouse business a specified service or trade business? So once again, a yes or no question, and if you have a moment here to provide us with your feedback, feel free to use the chat. Once again, through Zoom, at the top there, that green panel, click to the More option, and jump into the chat. And I'm curious to see what people are going to say about this one, because this is one I think can be interpreted several different ways. So take a moment here, folks. Give us a yes or no in the chat, and tell us what you think. Do you think Jake's computer warehouse, in this case, is considered an SSTB? So interesting responses. Somebody said yes. Somebody said yes and no, which I guess it kind of works. So take a moment here. We'll give a few more seconds to open the door for responses. And this is an interesting one, Sean, don't you think?
Yes, this is a good one.
A couple more people saying no, it looks like. Well, Sean, I'll give it up to you. What do you think? Is Jake's warehouse considered an SSTB given the situation here?
So first of all, I like that answer, yes and no. That's a good lawyer answer that I like to use. But actually, the answer in this case is no. And the reason is there is a special rule in the proposed regulations. We're calling it a de minimis rule. And it basically says if the business has gross receipts of 25 million or less, and less than 10% of those gross receipts are attributable to services in an SSTB, then you are not considered an SSTB. So in this case, because his consulting income or training income was so low, under 10%, the overall business is not considered an SSTB. So this is also a very taxpayer-friendly rule that the IRS put into the proposed regulations.
Awesome. And also to note then that if the gross receipts are greater than 25 million, that percentage jumps down to 5%. So less than 5% can be attributable to the performance of services of SSTB.
That's right. Yep.
Awesome. Okay, so this is a planning tip, and this is something I hope you guys can take away as kind of a takeaway for our session today, because this is an interesting one as it pertains to separating potentially service and non-service activities. So I've worked with numerous groups and audiences around the nation over the past month, and this is a conversation that really it tends to kind of become take a nature of its own as it relates to, should we look at separating service and non-service activities? And really it's going to be dependent upon what the tax practitioner thinks is the best. So Sean, I want to kind of ask you, based upon some of the conversations that you've had and the research you've done, is this planning tip something that folks should take in every single circumstance, or is this something that they should really look at circumstance by circumstance?
Yeah, you need to be very careful with this planning tip. So when 199A first came out, a lot of businesses decided to do this. So they decided to separate their service and non-service businesses. A lot of law firms did it. And the IRS said, wait a minute, we don't like what you're doing, and we're going to issue a anti-abuse rule. So watch out for that. And that's what they did with the proposed regulations. So as you see that third bullet point, an SSTB includes any business with 50% or more common ownership that provides 80% or more of its property as services to an SSTB. So a lot of people called this the crack and pack strategy, which meant if you had a law firm, for example, you would separate the law firm from the administrative staff. You would put them into separate legal entities, and the legal staff would provide, the administrative staff would provide services to the law firm in exchange for a fee. Well, that's what this anti-abuse rule does. It shuts that down. Now, you'll notice that you have to have 50% or more common ownership. So it is possible, if you're able to kind of get below that 50% threshold, that you can do this strategy. But I'm going to caution you guys, not everyone should do this. It's going to be put down by the proposed regulations. And when the final regulations come out, I would assume that this rule will still be in there. So no, it's definitely a case-by-case basis, paying attention to that rule.
Absolutely. And I like that phrase that you threw out there, crack and pack strategy. And that, I mean, it pretty much puts a clear picture on what we're trying to do with this separating or bifurcating, essentially, of businesses to take advantage of that rule. Now, the other rule that we want to throw out there as well is the aggregation rule. So rather than bifurcating the business, what about aggregating businesses together? And once again, to build off of what Sean said, we really want to make sure that we're taking this case by case. So you can see some of the information here, permitting taxpayers to combine separate trades or businesses if some of these requirements are met. So Sean, I once again want to kind of hear your insight or hear your take on this aggregation rule. Is this something that tax practitioners should consider for their business, for their taxpayers' businesses?
Absolutely. This is another taxpayer-friendly rule that the IRS put in the proposed regs. And the reason it's so good is you may have a business that does not have a lot of employees, or maybe it has no employees, or you have a business that doesn't have a lot of tangible property in the business. And what we'll talk about later is there is a limit based on W-2 wages and property held by the business if you are over a certain taxable income amount. So if you find yourself with a business with no employees, no property, but you have another business that has plenty of employees and property, you're going to want to combine those two businesses together under this aggregation rule because it will boost your QBI deduction. Make sure you meet these requirements, though. You have to have 50% or more of each trade or business. You must report them on returns with the same tax year. None of them are an SSTB. And then the last bullet point is really important. There must be some sort of connection between the two businesses. Maybe they have the same products, the same services, or there's some sort of supply chain interdependency, something like that, that must go together to aggregate these businesses. But if you can do it, it's probably very beneficial to do so.
Absolutely. And, you know, to add to what Sean is saying here as well, as I had combed through these, and I want to show this to you guys here for a moment, these are the draft version of your publication 535 here as released by the IRS. I think it was December 19th. They released this. So if you haven't already looked at this, make sure you're doing your own research and finding this out there on the web. And they had actually included, talking about this aggregation rule here, some supplementary schedules. So the Schedule B, which is what we're anticipating to be using here, to provide the IRS with some type of a statement around the aggregation that is occurring here. So this is outlined here in the draft version of the publication 535 there. And it provides some detail there on Schedule B, aggregation of business operations.
And it's really important to follow this schedule and put it in the return. Otherwise, the IRS has the ability to de-aggregate the businesses. So if you fail to put that schedule in, you're kind of, it's going to be really risky because the IRS can also go in and de-aggregate all those businesses that you just did. So make sure you follow this schedule.
Awesome. Yeah, great to hear. Thanks, Sean. Mm-hmm. Perfect. All right, well, we're getting some good information here, folks, around the separating of activities, combining of activities, trying to figure out what works best for different clients. Well, we want to continue the discussion here into that step-by-step approach. I know we've been taking some time here to really just talk about number one, right? And 8 easy steps, right? We've spent 30 minutes on step 1, and we haven't even scratched the surface yet. So this thing we can talk about it, I'm sure, between Sean and I for hours on end here. But now the next step is to know your client's taxable income. And this is extremely important as you look at reviewing maybe certain worksheets in your tax preparation software. Make sure you're identifying the client's taxable income prior to the QBI deduction amount. So I want to go ahead and share with you some slides here around why taxable income is so important, because the taxpayer income, the taxable income rather, before your QBI deduction is going to be what is gauging here our threshold. So whether or not SSTBs are qualified or not here, we want to make sure we're assessing what is the client's taxable income before the QBI deduction. And so once the taxable income reaches a certain amount, the deduction then is limited based on the business's wages and or unadjusted basis. So we'll get into that in a moment. We'll talk about your wage investment limit. So beyond why this is important, this slide here shows a very nice table to try to understand, first and foremost, between a non-service business and a specified service business, the difference between the two. And for taxpayers with income of $315,000 or less for joint, or $157,500 for non-joint filers, well, they're going to qualify for no matter what. So you've got 20% for both of those non-service and specified service businesses. But this is kind of where there's this phase in, phase out range, right? So between $315,000 to $415,000 of taxable income for married filing joint returns. If it's a non-service business, it's going to be 20% of QBI, but there's that wage investment limit that's phased in. And if it's a specified service business, you'll see the amount of income that is qualified business income is phased out while the wage investment limit is phased in. So interesting how that works. There's a phase out, but there's also the phase in. And then, of course, if they are earning as a joint return over $415,000, you'll see 20% for non-service businesses works, but specified service businesses, that's where if they're over that amount, they're not going to be eligible for the deduction. Once again, tables like this and others can be found from tools here that we offer like Quickfinder and other tax research solutions that we provide. So I'm going to get into our next example here, folks. And this is taking Julie, our first example. We had talked about Julie was our client. She's a partner in a successful law firm. And she, of course, has her Schedule K-1 coming from the law firm, showing ordinary business income of $500,000. But Julie also has her own side business. Julie's pretty busy here. So she's got a Schedule C. And in 2018, her retail Schedule C business generates net income of $400,000. So Julie in 2018 is going to be married filing joint, and their taxable income before the QBI deduction is $1.2 million. So the question here, folks, is how is their taxable income, the $1.2 million, going to affect Julie's QBI deduction? So take a moment, and to get some feedback and participation, feel free to use the chat. Once again, let us know if you have an idea of how the taxable income of $1.2 million is going to affect the QBI deduction. Take a moment to jump your mouse up to the green panel at the top of the Zoom screen there. Go to the little ellipsis ... button, click on more, and click on chat there, and let us know your thoughts. How do you think the taxable income for Julie is going to affect her QBI deduction? We'll give it a little bit of time here to see some feedback. And this is a great example because this is one where there are multiple business activities at play. And one thing I've been telling tax practitioners continually throughout the last month is as a core foundation to assessing this deduction, we need to make sure that we're evaluating all of the business activities for that client. So I think maybe we're waiting, some people are waiting on us to provide the answer because I'm seeing some question marks pop up here. So Sean, what do you think? How is Julie's taxable income going to affect her QBI deduction?
Well, like we said before, her taxable income is really high, right? It's 1.2 million. She's doing really great. So because her law firm is an SSTB, her $500,000 of ordinary income from that firm is not eligible for the deduction at all. So we can just throw that out. But with her independent business, her retail business, that $400,000 is going to be subject to the QBI deduction. However, since her income is so high, we're going to use that wage investment limit, which will possibly bring that deduction down. So that's how that taxable income works. It takes away the SSTB income and maybe limits the other income.
Awesome. So kind of assessing, hey, I've got one business here, which is the law firm. I've got a completely separate business as a Schedule C retail business. We want to make sure we're considering those separately and assessing the QBI deduction appropriately there. This is a good planning tip. I really like this next one because going back to the example we just talked about, what if the client has taxable income near or slightly over threshold amount? And Julie, I think, was not slightly over. She was pretty far over at 1.2 million. But what if we have clients with taxable income maybe around 400,000, 450, 500,000? What might be some tips for those types of taxpayers? And you can see the bullet points here potentially on some planning tips for those clients. Sean, can you speak maybe to some of these bullet points and maybe highlight some of that you see a lot of tax practitioners trying to encourage their clients to take?
Yeah, most are encouraging the retirement plan contributions, kind of up those so you can deduct those from your income. Another popular one is charitable contributions, but doing it through a donor-advised fund, which allows you to bunch deductions, so every other year. And getting married, I don't see that a lot. But if you do get married, your taxable income threshold goes quite a bit up. So, if you're in love, maybe just go ahead and do it. So
there you go. Hey, what better reason to get married than for tax purposes, right?
Right.
Awesome. Well, I want to share this next slide here, folks. And as we continue this discussion, we're just presenting as much research and information as we can to you. This is an awesome resource, which once again, if you're part of the Latino Tax Pro membership, we will be sure to send this slide deck out to everybody after the session is over. But it's a practical way to approach the discussion here as we talk about these thresholds, as we talk about the difference between a specified service trade business and a non-service business. And I think this really puts a great framework that any firm can use across any client example and ask themselves these questions and try to identify what's the best way to proceed with that particular client. So as we continue this discussion here, folks, please keep in mind that these checkpoint tools and research opportunities are available. If you simply search checkpoint or search Quickfinder Handbooks in Google, you'll see a lot of different resources like this out there. So without further delay, we're going to continue this here, step-by-step approach. We're flying by the seat of our pants, getting as much information in as we can. And this next one's important, identifying your qualified business income for each business. And this is where our calculation is going to come into play here. And we're going to talk about, well, what in the world is QBI? What is considered qualified business income? So this slide provides you with some basic items to include and to exclude. And you can see it's pretty straightforward here, including net amounts of income, including gain, deductions, loss from qualified trade or business, conducted within the U.S., Section 751 gains, Section 481 adjustments, and we're excluding investment income, guaranteed payments to partners, Section 707A payments. Various other things here are excluded as well. So we want to make sure that we are addressing what's included and excluded. And remember, the IRS has recently released the draft version of Publication 535, which does include some further definition of this as well. So we're going to continue our examples. I like these examples. These are really fun because it helps put some practicality behind this whole QBI deduction thing here. So as we continue this next example, we're going to talk more about Julie here. And Julie has got a lot going on. As you can see, she's a partner in a law firm. She's got a K-1 showing ordinary business income of $500,000. And her K-1 also shows a guaranteed payment of $100,000. Julie's got her Schedule C on the side, remember, with $400,000 of net income for her Schedule C there. In addition, Julie's receiving a qualified REIT dividend of $20,000 and a non-REIT dividend of $10,000 in 2018. So Julie's going to be filing jointly with her spouse, and they have taxable income over $1.2 million prior to the QBI deduction. So this is an interesting question, and I'm not sure if we're going to get any responses. How many people have their calculator ready to go here right now? But the question here, folks, if you want to give us an answer, how much QBI does Julie have for 2018? So doing a quick calculation in your head, if you think you know the number, give us a number in the chat. Let us know. Use the Zoom functionality there. Let's send a quick chat out to everybody that says use the chat here. So if you think you know what Julie's QBI is going to be for 2018 with this example, let us know. I'll be happy to give you some kudos. I can't give you much else, but some kudos for it. So I'm not seeing any responses quite yet. So I think once again, Sean, they're waiting on us to give the answer.
Okay. Let's break it down. There's a lot here. So let's just go item by item. So the $500,000 from her law firm, we've already determined that's not QBI because she is a specified service trade or business. Now let's look at the guaranteed payment of $100,000. That is excluded from the definition of QBI by the statute. So that guaranteed payment is not QBI. So let's look at her independent retail business. The $400,000 is QBI, okay? But it'll be subject to the wage investment limit, which we'll talk about later. The qualified REIT dividend is not considered QBI. However, we'll talk a little bit more about that later. It does factor into the deduction at some point. And then the non-REIT dividend of $10,000 is not QBI because we have to exclude investment income. So really all she has is $400,000 of QBI from her retail business.
Perfect. So a lot of things at play with Julie's situation here, kind of narrowing things down, her QBI amount in this situation based on just this initial direction here, we're saying she's got $400,000 of QBI. So as we continue this discussion, you know, what if there is a loss, right? What if it's a qualified business loss, essentially, instead of an income amount? So you can see here that we're able to carry that forward and treat that loss as qualified, as a loss from a qualified trade or business in the next year. But remember, there is a netting rule in this case. So if a client does have multiple businesses that may have QBI amounts, we're looking to net those together when we combine the amounts here, and you must allocate your net loss from an unprofitable business amongst all businesses that do produce QBI in proportion to their respective QBI amount. So that's something you want to review your tax software and the calculation and worksheets that your software is generating that shows how your various clients' businesses may be netting together as needed. And then, of course, that wage investment limit, which we're going to see in a moment, is going to apply after the netting occurs. So some very important things to be on the lookout for if we do have a loss as well. Well, folks, as we continue on here, after you identify the QBI for each business, the next thing is to compute the deductible amount. So to compute our deductible amount here, we're looking to identify, well, what is the deductible amount? First and foremost, generally it's the lesser of your qualified business income deduction, 20% of that, or the wage investment limit. So as we break these two down here, we want to identify, well, first of all, what's our QBI number, but then also what is this wage investment limit as well? So the wage investment limit is generally the greater of 50% of your W-2 wages paid by the business, or 25% of W-2 wages paid by the business plus 2.5% of the unadjusted basis of qualified property. So now this is where things are getting a little bit murky. We can take several directions based upon what is the greater of here in this case. And so as you evaluate this wage investment limit, well, we got to figure out how is the QBI identifying wages in its definition here. And wages, as you can see here, W-2 wages per IRC 199A are total wages subject to withholding, elective deferrals, and deferred compensation paid by the business during its tax year. Compensation must be properly allocable to the QBI, and the businesses must file Form W-2s reporting those wages. Now, when you have wages allocable to multiple trades or businesses, there are some bullet points here you want to be on the lookout for. One of them I think is extremely important, and I've heard multiple people mention this over and over and over again, is this third bullet point: businesses' books and records must reflect the chosen methods. You want to make sure that your client's businesses have the proper books and record keeping behind what are the wages and the allocated amounts of where wages need to go to. So make sure you're reviewing the definition of wages and how those are going to be applied to your qualified business income calculation, and in particular the deduction there. Now, the other part to this discussion, folks, is remember our unadjusted basis of qualified property. So what is that, and how is that calculated? This is going to be your depreciable tangible property held by the qualified business. So exclude land, exclude any undepreciable assets available for use at the end of the year. It has to be qualified there. It has to be used to produce QBI, and the depreciable period hasn't ended before the close of the year. Now, there's also a clause here where folks are saying 10 years, has to be the later 10 years from place in service date. And I'm curious, Sean, because I've been getting some, I don't know, debate around what should or should be included. It seems like some people say, you know, hey, it should be 10 years from date of place in service. Other people say it should be all assets. What do you say, Sean? Is there something here where we should rely upon, hey, we know it should be assets that are placed in service no later than 10 years from the date?
Well, it's the later of 10 years or the last day of the full year of the recovery period. So let's say you have a 3-year asset that does qualify here. It's used to produce QBI. Basically, you're allowed to count that basis, not just for 3 years, you can count it for 10 years. So that's a really good thing. If you have a 39.5 year, you're going to go all the way out to 39.5 years. So it's long as the period hasn't ended and the assets used to produce QBI, then you're okay. You can count those assets.
Great. Okay, great. That helps me because I was a little bit murky on that. And
yes.
To clarify. You know, there's an interesting question in the chat, and I wanted to address this question that came in on QBI. And a gentleman is asking, in an example for a single owner S Corp, the active owner will have a W-2 and a Schedule K-1. And the question is, how is the K-1 affecting QBI, or how will bonus and direct fees affect it? So, Sean, I want to go ahead and see what you think on this question here and provide an answer to the gentleman in the chat.
Yeah, that's a great question, and I get that question a lot. So the bottom line is, whatever is reported as ordinary income on the K-1, that's generally going to be your QBI amount. Now, how that works is any type of wages that is paid to the single owner, including bonuses, that technically is going to reduce QBI, right? Because you're taking the gross receipts minus the wage expenses, okay? So it kind of does two things. Number one, it reduces QBI by paying the wages, but you must pay a reasonable wage, right, for an S corporation owner. But on the other hand, wages paid to an owner are not considered QBI. So there's this kind of balance you have to obtain here, is how can you get a reasonable wage to an S Corp owner without lowering the QBI amount too much? So that's kind of how there's an interplay here between wages, bonuses, and then the QBI amount for an owner.
Awesome, awesome. Thanks so much, Sean, because that's actually a great question. I want to kind of segue into this next planning tip here if we can. I'm just going to, for the sake of time, skip past this next example and some of these other slides very briefly, because this planning tip is important. And I think it kind of goes off of what we were just talking about with considering reducing wages. As you can see, one of the planning tips here is to increase QBI, consider reducing wages. But as Sean said, if it is the primary owner or the owner of the S Corp, that would, and correct me if I'm wrong here, Sean, that would reduce QBI, is that right?
Yes. Yeah,
Okay.
so the more you pay in wages, the less you get in QBI. And the follow-up question here is, how about income to a wife? And the wife is not an owner? It's the same thing. Any type of W-2 wages is going to reduce the owner's QBI. However, the more you pay in W-2 wages, the better you get on your wage investment limit. So there's kind of a contrast here. It's kind of they're fighting against each other.
Perfect. So, and that's a huge point to make. There's a give and take, right?
Yes.
And I see that this tax season, moving into next tax season and in future years, there's going to be a lot of tax practitioners trying to evaluate, what should I do for my clients? Should I increase wages? Should I reduce wages? How does that impact my QBI and their overall bottom line? So one tool that I want to introduce here, folks, is an advanced tax planning tool that I have been working with firms recently over the past 6 to 9 months here in just a lot. They've been using this system a lot here, something called Planner CS. And Planner CS is something you want to ask yourself, if you're a tax practitioner listening in to this discussion right now, ask yourself, do I have clients with businesses? And the answer is yes. The subsequent question you want to ask yourself is, do I need to evaluate an advanced tax planning software to use in my office? And so this Planner CS application is an advanced tax planning software that can be used as a supplement to your current tax application, whatever that tax program might be. And I really love using this product here. One of the tools that we offer, I'm going to open up a plan in this software. And this is a plan in which you're essentially entering in the data, and it's comparing directly for you what would be the value for your taxpayers if they filed as an S Corp versus as if they filed with a sole proprietor. And then to throw in the discussion of, well, what happens if we try to reduce wages if they were an S Corp? Well, if I come out here to my summary, we can kind of evaluate and you can analyze these numbers and you can really play around with this. This is where that give and take, playing around with some of these numbers can happen, because you can see here their income, whether they file as a Schedule C or an S Corp, is going to be the same. But as I come down here and I jump into the income section, notice here as they file as S Corp, we've got 80 grand of wages, and we've got the K1 income here of 145. Well, if it's a Schedule C, it's business income or loss, and the total income or loss is the same. But we want to maybe reduce wages. So if I double click into the wages area, I can completely reduce the wage number here, maybe by 20,000, just to see what that does for my bottom line. And when I do that, now I go back to my main summary screen, and it shows me now the update to the income amounts, and I can come down here to the bottom line, see my total income taxes, I can see my summary amounts here, and I can see the total tax due refund, and you're able to run reports from this system. And I see a lot of firms that use this application to create practical tax plans for their clients, and then they can generate reports based upon some of the advisory services that they're providing to their clients. So one of the tools, and I have to share this tool because as we talk about wages, one of the things that we do have here to work with is this wage projector. So if I have a new employer, a new W-2, and maybe my client's a Schedule C, and we're evaluating should they go to an S Corp status. Well, if I do a wage projector tool here in the system, I can say based upon either a year-to-date pay stub or a single pay stub, single payment, I can plug in amounts here and evaluate what the projected wages should become. So maybe we've got year-to-date payments, and it's a weekly employee here, and the year-to-date is from 01, we'll say 01, if I can get the right numbers in the right spot, 31, 2018. So once I plug in the year here, and I plug in maybe what the federal taxable wages were for that pay stub, we'll say $4,500. It's going to give me the projected numbers. If I tell the system what the Social Security wages were, It's going to give me what the projected number should be. So as you plug in these values, it's going to go ahead and calculate that for you. And when I hit OK, it pulls in those numbers here, and I hit OK again, and now that's going to update my entire plan. That calculation will then go through the entire system and take into effect here in our QBI deduction, and this system provides a duplicate, or essentially a copy of the worksheet that the IRS has released to calculate your QBI deduction. So with this entire conversation, we're talking about a lot of complex calculations here, folks. These tools are things that we want to be able to put in your hands and for you to evaluate, is this something that I should use in my office? Whether it's business clients that you have, clients you're managing their businesses and providing them advisory services on, or maybe it's just a 1040 client you want to evaluate what should their withholding be. This is a system that can do those types of calculations for you. So, you know, as I said before, I feel like we could be here for hours on end, folks. There are further examples in this slide deck. As I said, we will be making sure that we provide this slide deck to any of you who are attending the session here today. But as we approach our ending time frame here, I want to make sure to wrap up with a few final things. And of course, our step-by-step approach. There's, as I said, there's a lot to talk about. So unfortunately, we want to go ahead and wrap up here. Some additional examples there around Julie's situation, our taxable income limit, and some more examples there. So to calculate your final deduction, folks, remember that your deduction amount is going to be calculated from step 6, and we're going to also mention there are cooperatives. If you have qualified cooperatives there, payments from cooperatives, you want to include that in the calculation as well. And then finally, you have to report the deduction. This is where we kind of bring everything full circle. And so I'll just kind of wrap up with a few of the entity reporting responsibilities here. Can you take a moment just to explain from the business entity standpoint, what exactly would a tax practitioner advise their clients when they're producing Schedule K-1s and creating the business returns?
Yeah, this is super important according to the proposed regs. If you represent a client that has a business with a Schedule K-1, you're going to need to make sure that the K-1 lists all of these things you see on the screen, including whether the business is an SSTB. That is incredibly important. The thing to remember is if you don't report these things, so you report the share, the owner's share of QBI, wages, qualified property, things like that. If you fail to report this on the business return, the IRS will assume that those items are zero. So this is really important. For example, if you represent the owner of an entity, but you do not prepare the business return, you need to make sure you have good coordination with the person preparing the business return to make sure that these things are indeed being reported. Otherwise, the items are presumed to be zero and you don't get a QBI deduction, and that would be really bad.
Yeah, so definitely some due diligence. I want to make sure we're reviewing those K-1s here, and of course your individual compliance considerations as well. The one thing I'll mention here, folks, is that on your new 1040 postcard, line 9 of that postcard is where this is going to end up. And of course, there are going to be some worksheets that you want to consider as you review publication 535 as well. So hopefully we've given you some good information here today, folks, and as we continue throughout this tax season, evaluate some of these helpful Thomson Reuters tools. We have our Checkpoint News side of things, which I know Sean works with and is directly involved with. We have our Quickfinder Tax Handbooks, which I showed you a little bit of here today, and our Planner CS application as well. If you guys are looking for information on how to acquire these, there are a couple of phone numbers right on the slide here. If you want to access Quickfinder Handbooks, there's a phone number there, 1-800-431-9025. And if you're looking to evaluate our Planner CS product or any other of our software products as well, you can reach out to our sales team at 1-800-968-8900 also. If you have any questions for myself or Sean, find us on LinkedIn. I'll be happy to connect with you guys. And I appreciate, once again, Latino Tax Pros for this opportunity. And I'll go ahead and now, on behalf of Sean and I, pass it over to Antonio and Nick.
Fantastic. You guys sure know how to put some good information together, and I like the way that you place it all in one place and you make it very simple, because believe me, as I read all the regs, it is not simple. It's more legalese and lawyerese. So thank you, especially Sean, for being able to put that into something that's more the common person's lingo. And if there aren't any other questions, I want to thank you for your time. And by all means, get a hold of them or give us a call as well. And we'll be glad to work with all of you. And hopefully you have a very successful tax season.
And one thing, Nick, before we wrap up, I did see a question, somebody asking, is there a special discount on the Quickfinder Handbook? And the answer is yes. For Latino Tax Pro members, there is a special discount both for the Quickfinder Handbooks and the CS Professional Suite Planner CS product. So when you reach out to the numbers on the phone line there, make sure to mention that you're a member of Latino Tax Pros, and there's a special discount for you guys, of course.
Wonderful. Thank you very much.
Hey, anytime. Thank you, Nick. You guys have a great day, and take care of the rest of the tax season. Bye-bye.
Thank you.